Imagine a life where your money waits for you while you sleep. In today's video, I'm going to show you how to start investing in 5 easy steps. These steps will help you create wealth, improve your financial situation, and set yourself up for success. We will also look at a few examples of young people who started investing earlier and now millionaire. Let's start. The first step is starting by setting the clear financial goals. Before you start investing, you need to ask yourself a simple question. What are you investing for? Your answer may be you are investing for retirement, buying a car, starting your own business, or maybe traveling the world. Your goals will guide your investment decision. For example, if you are 20 years old and now you want to retire by 50, you have 30 years to build wealth. That is your long-term goal. If you are unsure about your goals, start small. Maybe your goal is just to start saving and building wealth. Even a goal as simple as I want to grow my saving by 10% this year can give you direction. Having a goal in mind makes investing more meaningful and help you stay motivated when the market is up and down. Let's take an example of Grant Sabita, a young millionaire who started with just $2.26 in his bank account at the age of 24. With a goal to save and invest aggressively, he turned his financial life around. He started investing in index fund and real estate, and by the age of 30, he had saved $1.25 million. It all started with the goal of financial independence. After setting a goal, then we jump into second step, which is starting with what you have. There is no need for big money. What does it mean? It means that you don't need to be rich to start investing. In fact, some of the richest people today started with very little money. Thanks to technology, anyone can start with as little as $50. Many investment platforms like Robinhood, Wealthfront, or Archons allow you to invest a small amount in stock or even fractional shares. Whereas fractional shares mean you can buy a small part of a company stock like Apple or Amazon without having to pay the full price of one share. For example, if Apple stock costs $150 but you only have $50, you can still own a fraction of the share. Over time, as the stock value increases, your small investment will also grow. Ever heard of Alex Banayan? He is a young investor who started investing his small saving when he was just 18 years old. He learned the power of compound interest and invested in tech stocks. Today, he is at the age of 32. And guess what? He is best-selling author and multimillionaire. Step number 3 is this. Choose simple and safe investment for you. Once you have set your goal and saved a little money to invest, the next question to pop up in your mind is, where do I invest? And the great option for beginner is index fund. Index fund means you are investing in a basket of different stocks, which means your risk is spread out. Instead of trying to pick individual stocks, which can be risky, you are investing in the whole market, like the S&P 500. Historically, index funds provide a stable and solid return over time. Another safe investment option is bond. These are loans you give to the government or companies in exchange for interest payment. While the returns are smaller compared to the stock, they are much safer, especially in a certain time of inflation. Let's take an example of Warren Buffett, one of the richest in the world. He has been recommending index fund for most investors. Even though he is billionaire, imagine, he still says that index funds are one of the best ways to grow wealth steadily. Let's say you invested $1,000 in the S&P 500 in the year of 2000. Today, that investment would be worth nearly $5,000. This makes us fall into the fourth step, which is automate your investment. Now that we have discussed where to invest, the next step is to make it automatic. You are more likely to succeed in the investing if you don't have to think about it every month. Many investment apps allow you to set up automatic transfer from your bank account. For example, you could decide to invest $100 every month without having to manually make the transfer. This method is called dollar cost averaging. It means you invest a fixed amount regularly, no matter what is happening in the market. When prices are low, your money buys more share. When the prices are high, you buy fair share. But over time, your investment will grow. Automating the process removes the stress and ensures you are consistent. Hence, the secret is consistency and automation. And lastly is to stay patient and don't panic. While doing all the steps above, keep this in mind. Patience is key in investing. You may see your investment go up and down in value, but this is normal. Don't panic when the market dips, because long-term investment tend to grow over time. Let's take an example of 2008 financial crisis. Many people panicked and sold their stock. However, those who held on to their investment saw their portfolio bounce back even stronger. The key to building wealth is to stay calm and keep investing regularly. Successful investors focus on the long-term gain, not the short-term loss. Take up note. Investing doesn't have to be complicated. Start with what you have. Keep it simple and most importantly, be patient. Following these 5 easy steps can help you build wealth and reach your financial goals faster than you might think. If you enjoyed this video, don't forget to like, comment and subscribe to my Wealth Wizard channel for more tips on growing your money. And remember, it is never too late or too early to start investing.